Buffett believes it is foolish to use short-term prices to judge a company's success. Instead, he lets his companies report their value to him by their economic progress. Once a year, he checks several variables: return on beginning shareholders' equity, change in operating margins, debt levels, and capital expenditure needs, and the company's cash generating ability. Investing the Warren Buffett way. Turn off the stock market. Remember that the stock market is mainly impressive. Sometimes it is widely decided about future prospects. If you believe that the stock market is smarter than you are, give it your money by investing in index funds. But if you have done your homework and understand your business and are confident that you know more about your business than the stock market does, turn off the market.
In the early 1990s, Forbes magazine list of America's richest people. Warren Buffett is one who obtained top 5 position, for whom the source of wealth from the stock market. Warren Buffett was born on August 30, 1930 in Omaha, Nebraska. He was the second of 3 children and the only boy. His father was a stockbroker and 4-term United States congressman. At 11 years old, he made his first investment, buying 3 shares of City Service Preferred at $38 per share. The stock quickly dropped to only $27, but Buffett held on tenaciously until they reached $40. He later cited this experience as an early lesson in patience in investing. At the age of 25 in 1956, Buffett started an investment partnership. He had 7 limited partners who contributed $105,000, and Buffett as general partner put $100. The limited partners received 6% interest per year and 30% of the profit generated above this level. Buffett was paid the other 25% over the next 13 years. This partnership compounded investment at an annual rate of 29.5%. In 1965, Buffett closed the partnership and cashed out.
Chapter 3 discusses about our main business is insurance. Buffett is a great stock picker and knows a value company when he sees one. Buffett thinks textile business made high returns on equity improbable. Textiles, commodities by definition, have a difficult time differentiating their product from those of competitors. The textile mills would require significant capital improvement. He thinks that the textile mills were the largest employer with an older age group with non-transferable skill. He believed that the textile business could gain some profits. In 1980, it seems the future of the textile group is not really good. In July 1985, he closed the book on the textile group. He learned a valuable lesson about corporate turnaround and enough capital to buy an insurance company. Buffett started buying insurance company in 1965 in Nebraska, National Indemnity Company and National Fire and Marine Insurance Company. Sometimes insurance companies are good investment, sometimes not. In 2 years, he managed to increase the stock and bond value of both companies by $11 million. After his first 2 insurance company purchase, he set his sight on Geico and bought a large quantity of stocks and made Geico a profitable company as well. Buffett's interest in the company continued to climb. Berkshire's buying the entire company, and in 1996, Geico officially became a wholly owned unit of Berkshire Hathaway, managed independently from Berkshire other insurance holding. Reinsurance is a sector of the insurance industry not well known to the general public. In simple terms, reinsurer insures other insurance company. This, in fact, was a key part of Buffett's strategy in buying the company. The reinsurance industry offers huge potential, and a well-run reinsurance business can create enormous value for stakeholders. Buffett understands the insurance business in a way that few others do. His success derived in large part from acknowledging the essential commodity nature of the industry and elevating his insurance company to the level of franchise. His goal was to always write large volume of insurance but only at price that makes sense. In Chapter 4, Buying a Business, Buffett and his company are expert at buying companies. He owns over 100 of them. This chapter introduces the reader to a key fundamental, whether you own stock in the company or own a company outright. You own the company. Buying large amount of stock in the company gives you partial ownership. But Buffett says it never allows you to do what he likes most, and that is capital allocation. If you do not own a company, you cannot tell officers what to do with money and when. And that is a negative to Buffett. This chapter also discusses what Buffett looks for when buying a company. One of the main things is he only buys companies he understands. If he buys a company which is too complex or makes a product he does not comprehend, he risks losing large sum of money. Buffett's set of basic principles are tenets that guide his decision into 4 categories: business tenet, management tenets, financial tenets, and value tenets. Buffett chooses to invest in a company. He is buying a business, not a piece of paper. Buffett will avoid commodity business and managers in which he has little confidence. He will purchase a company that he understands, one that possesses good economic and is run by trustworthy managers.
In this chapter 5, this book tells us about Buffett's investing guideline for business tenants. Buffett concentrates on learning all he can about business under one situation, focusing on 3 main areas. First is the business simple and understandable. Buffett's view, investor understandable financial success is correlated to the degree in which they understand the investment. His modus operandi is to buy companies that are already successful and still have potential for growth. Second, does the business have a consistent operating history? Buffett achieves strong returns through investing consistently in companies that have been successfully producing and selling the same product or services for several years at least. And the third, does the business have favorable long-term prospects? According to Buffett, the economic world is divided into small group of franchises, a much larger group of commodity businesses of which most are not worth purchasing. He defines a franchise as a company providing a product or service that needed or desired, local substitute, and not regulated, so it can regularly increase price without fear of losing market or unit value. They can therefore earn above average returns on invested capital. Buffett said that I want to be in business so good even a dummy can make money. In this chapter says this book tells us about Warren Buffett's investing guideline in management tenets. Buffett pays a lot of attention to the quality of management. He only invests companies that are operated by honest and competent people, managers for whom he can feel admiration and trust, which specifically consists in 3 main areas. First is management rational, second is management candid with the shareholders, and third, does management resist the institutional imperative. Management rationality is the quality Buffett believes distinguishes management style. The most important management act Buffett believes is allocation of the company's capital. It is the most important because allocation of capital over time determines shareholders' value. Deciding what to do with the company's earning, reinvest the business or return money to the shareholders, is in Buffett's mind on an exercises and logic and rationality. 2. Are managers reporting their company's financial performance fully and genuinely? Are they admitting their mistake as well as sharing their success? Are they candid with shareholders in all ways? Buffett holds in high regard managers who report their company's financial performance fully and genuinely, who admit mistakes as well as share successes, and who are in all ways candid with shareholders. In particular, he respects managers who are able to communicate the performance of their company without hiding behind generally accepted accounting principles or GAAP. Imperative resistance. Nonsense force that Buffett calls as the institutional imperatives is the lemming-like tendency of corporate management to imitate the behavior of other managers, no matter how silly or irrational that behavior may be. Even when managers accept the notion that their company must radically change or face the possibility of shutting down, carrying out this plan is too difficult for most managers. Once out in the business world, prevalent instead that rationality frequent wills when the institutional imperative comes in that in evaluating people you look for three qualities: integrity, intelligence, and energy. If you don't have the first, the two other will kill you.
Buffett does not take yearly results seriously. He focuses in 4 or 5 year averages. He relies on a few timeless financial principles, such as focus on return on equity, not earning per share. Calculate owner earnings to get a true reflection of value. Look for companies with high profit margins. And for every dollar retained, has the company created at least $1 of market value? To use this ratio, we need to make several adjustments. First, all marketable securities should be valued at cost, not at market value. Second, control the effects that unusual items may have on the numerator of this ratio. And the third is employing little or no debt. Buffett warns that earning per share is not the ending point. Even cash flow is not a perfect tool for measuring value. Instead of cash flow, Buffett prefers to use what he calls owner earnings, company's net income plus depreciation, deflation, and amortization, less the amount of capital expenditures and any additional working capital that might be needed. Paradoxically, managers of high-cost companies tend to find ways to continually add to their overheads, whereas the managers of low-cost operations take pride in lowering their expenses. Any money spent on unnecessary costs deprives shareholders of extra profits. The culling of unnecessary expenses is a consistent theme of effective managers. Buffett's goal is to select companies in which each dollar of return earnings is translated into at least $1 of market value. Over the longer term, soft market value will accurately reflect the economic value of the company. The same is true for increased market value created by return earnings. A well-managed company will add at least $1 of market value for every dollar of return earnings. Buffett remarks, price is what you pay, value is what you get. The rational investing has two components. First, determine the value of the business. The second, buy only when the price is right, when the business is selling at a significant discount to its value. To calculate what the business is worth, Buffett and many others use Williams' dividend discount model. The value of a business is the total of the net cash flow or owner earnings expected to occur over the life of the business, discounted by an appropriate interest rate. Net cash flows are the company's owner earnings over a long period. The margin of safety principle is still become Buffett guiding principles. It assists Buffett in two ways. The first, protect him from downside price risk. Second, provide opportunities from extraordinary steep returns.
About a margin of safety. You don't drive a truck that weighs 9,900 pounds and says limit 10,000 pounds because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you're trying to cross.
Therefore, the investment tenets described, the business tenets will give you focus on companies that are relatively predictable. The management tenets will keep you focused on companies that are well-run. Together, the business and management tenets will give a good sense of the company's future earnings potential. The financial tenets will reveal the numbers you need to make a determination of the company's real value. And the last is, the value tenets will take you through the mathematics necessary to come up with a final answer. Based on everything you have learned, is this a good buy?
Chapter 9. Investing in Fixed Income Securities. In this chapter, Hagstrom uncovers some of the shrewd investments Buffett has made in fixed income marketable securities. Berkshire make investment in municipal bonds, such as in Washington Public Power Supply System, RJR Nabisco, Level 3 Communications, Quest, and Amazon.com. For WPPSS, Berkshire purchased the bonds at a 32% discount to book value, doubled in price while annually paying Berkshire a return of 15 to 17% tax-free. Buffett acquired $440 million in disnegation-counted RJR bonds. In the spring of 1991, RJR bonds rose 34%, producing a $150 million capital gain for Berkshire Hathaway. This chapter also presents an example of how Buffett achieved an annual return of about 25% pre-tax using a risk-assessed arbitrage strategy. With risk arbitrage, a stock price trades in the market at a discount to some future value. Buffett also invested in convertible preferred stocks. Convertible preferred stock is preferred stock that can be converted into common stock as of a predetermined date at a specified ratio. On 2000, Berkshire acquired 34.56 million shares of convertible preferred stock along with 900,942 shares of common stock in Mid-American Energy Holdings Company. Chapter 10. Managing Portfolio. This chapter explains about Buffett's approach to manage the portfolio, which he calls focus investing. The golden rules of focus investing. 1. Find outstanding companies. Concentrate your investments in outstanding companies run by strong management. 2. Less is more. Limit yourself to the number of companies you can truly understand. 3. Put big bets on high probability events. Pick the very best of your good companies, and put the bulk of your investment there. 4. Be patient. Think long term, 5 to 10 years, minimum. 5. Don't panic over price changes. Focus investors tolerate the bumpiness because they know that in the long run the underlying economics of the companies will more than compensate for any short-term price fluctuations. This chapter also tells about Buffett's view in risk, diversification, and efficient market theory. Buffett's definition of risk is a factor of the intrinsic value of the business, not the price behavior of the stock. Buffett's view on risk drives his diversification strategy. By purposely focusing on just a few select companies, you are better able to study them closely and understand their intrinsic value. Modern portfolio theory protects investors who have limited knowledge and understanding on how to value a business. But that protection comes with a price. The challenge of focus investing. The ability to withstand that volatility without undue second-guessing is crucial to your peace of mind, and ultimately to your financial success. The key is to keep your emotions in appropriate perspective, and that is much easier if you understand something of the basic psychology involved.
When it comes to investment decisions, our behaviors is sometimes erratic, often contradictory, and occasionally goofy. Sometimes our illogical decisions are consistently illogical, and sometimes the pattern is discernible. Much of what drives people's decision about stock purchases can be explained only by principles of human behavior. And since the market is by definition a collective decision made by all stock purchasers, it is not an exaggeration to say that psychological forces push and pull the entire market. We will talk about behavioral finance. First, overconfidence. Several psychological studies have pointed out that errors in judgment occur because people in general are overconfident. Confidence per se is not a bad thing, but overconfidence is another matter, and it can be particularly damaging when we are dealing with our financial affairs. Overconfident investors not only make silly decisions for themselves, but also have a powerful effect on the market as a whole. Overreaction bias. The behaviorists have learned that people tend to overreact to bad news and react slowly to good news. Psychologists call this overreaction bias. Thus, if the short-term learning report is not good, the typical investor response is an abrupt, ill-considered overreaction, with its inevitable effect on stock prices. Loss aversion. According to behaviorists, the pain of a loss is far greater than the enjoyment of a gain. Many experiments have demonstrated that people need twice as much positive to overcome a negative. On a 50-50 bet, with precisely even odds, most people will not risk anything unless the potential gain is twice as high as the potential loss. This is known as asymmetrical loss aversion. The downside has a greater impact than the upside, and it is a fundamental aspect of a human psychology. Applied to the stock market, it means that investors feel twice as bad about losing money as they feel good about picking a winner. Mental accounting. A final aspect of behavioral finance that deserves our attention is what psychologists have come to call mental accounting. It reverses our habit of shifting our perspective on money as surrounding circumstances change. We tend to mentally put money into different accounts, and that determines how we think about using it. Risk tolerance. In the same way that a strong magnet pulls together all the nearby pieces of metal, your level of risk tolerance pulls together all the elements of the psychology of finance. The psychological concepts are abstract, where they get real is in the day-to-day decisions that you make about buying and selling. And the common thread in all those decisions is how you feel about risk.